What's up everyone, it's Kadi with Money Investing. In this video, we are going to be talking about the debt ceiling and the debt limit in the United States because the probability of a default has more than tripled in the last few weeks since the beginning of this year when it was at 3.3% to now sitting at well over 11% probability that the US is going to default on its debt. And I don't have to say it, but the consequences of a default on the national debt is going to be absolutely catastrophic and devastating. So in this video, my goal is to kind of explain to you how the entire process works. What is the national debt? How do we get into this situation, and what are going to be some of the potential outcomes and consequences moving forward? So hope you guys enjoyed this video. It's going to be a little bit educational / analysis. So as always, make sure that you drop a like and of course subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below if you're interested in joining us. And there is a 16% annual discount available for a limited time till the end of this month. And you'll get access to all the buy and sell alerts, options alerts, trade ideas, all the private videos and tutorials and lectures, all the benefits. Links going to be down below. So this right here is the report that actually came out very recently at the beginning of March. So the implied default probabilities have increased to levels not seen since the 2013 debt ceiling debate. And the probabilities of a debt default have soared from 3.3% at the start of January to 11.3% last week. So we have substantially, it has more than tripled, and the risk is growing day by day. So my goal in this video is to kind of walk you through exactly what is going on. So first of all, what is the debt ceiling? Now, debt ceiling, think of it as a cap, right? There's a cap on the amount of money that the US government, Treasury Department, can borrow to run its day-to-day operations, right? Think of it as your personal cap. If you are running a household, if you're running a business, right? There's a certain limit that you can borrow, right? Think of it as a credit card, right? Let's say that you have a $5,000 limit on your credit card, right? If you hit that $5,000 limit, that's it. You can't borrow any more. And if you need more money to run your day-to-day operations for your business, or if you're in a household, if you want to provide for your family, whatever it is, if you hit that debt ceiling, there's only two things you can do: pay down the debt so that your limit there's some leftover limit, or increase the limit. Call your bank and be like, hey, I need more money to borrow. I need to raise my limit, right? There's only a couple things you can do. Think of it that way as the debt ceiling. Now, created by Congress in 1917, the debt limit or the ceiling sets the maximum amount of outstanding federal debt the U.S. government can incur. As of January 2023, the total national debt and the debt ceiling both stand at a whopping $31.4 trillion, and the U.S. government has run a deficit averaging nearly $1 trillion every year since 2001, meaning it spends that much more money than it receives in taxes and other revenues. So fiscal deficit is very, very simple to understand. It's bringing in less money than it is spending, right? So the U.S. government has been spending more money than it's bringing in. It's just plain and simple, right? Again, go back to the analogy. If you are, in a household, if you're providing for a family, if you are spending more money than you are generating through income, every single month, every single year, you're running a deficit as opposed to surplus, right? And if you run a deficit constantly, what's going to happen? You're going to borrow more and more money, and the debt mountain continues to grow. And that's exactly what's going on with the US, and it's been going on with the US for several years now, pretty much decades. Now, this right here is a very good chart, which pretty much goes over the debt ceiling line in black and the national debt of the US, broken down by different parties. And again, I don't want to get too political in this video, but there's a very good analysis being done here. And what you can see is obviously the debt ceiling has been raised since 1980s, constantly the last 40, 50 years. The debt ceiling has been consistently raised, and the debt itself has grown to over $31 trillion. I think by the end of this year, it'll be closer to 32.7, closer to $33 trillion. And the key takeaway here, again, is just the amount of spending the U.S. has done, regardless of who's in charge, right? Regardless of who's in office. But of course, since 1960, Congress has acted 78 separate times to permanently raise, temporarily extended, or revise the definition of the debt limit. 49 times under Republican presidents and 29 times under Democratic presidents. And again, I don't want to get too political in this video, but that's where we are. But I think in going back as far as 1980s, you've also have had more Republican presidents than you've had Democratic presidents. Don't quote me on that, but I think that is also true. So, just by law of math here, you will most likely have more debt ceilings being raised by Congress under Republican being in office versus Democrat. Now, moving forward, this is going to be one of the riskiest debt showdowns since 2011, and the reason is because the probability is rising, and unfortunately, we do have people in Congress that could cause some economic damage to the United States because of just where we are in the government, right? There's just so much divide, and there's just so much controversy and conflict within the office, within Congress as well. So Wall Street warns for riskiest U.S. debt limit showdown since 2011. So Wall Street banks, including JP Morgan and Goldman Sachs, are warning that Washington is heading for the riskiest debt ceiling confrontation since 2011, when the U.S. lost its risk-free credit rating. So what happened was back in 2011, the U.S. under Barack Obama pretty much came down to the last hour before it raised its debt ceiling. That was one of the reasons why it lost its AAA plus rating, its credit-free, risk-free rating down, and was downgraded to AAA. Right back in 2011. And Congress has many tussles over lifting of its borrowing limit in recent years and has never defaulted on its debt. But given the particularly fractious state of the legislative body, a deal to stop the world's biggest economy from defaulting on its debt may be harder to seal this time. So this is a good visual representation of how it actually works. So once the U.S. government, the Treasury Department kind of hits that debt ceiling, then it goes into what's called extraordinary measures, right? So extraordinary measures run for a certain time, and these are measures taken by the Treasury Department to maybe cut spending, to maneuver savings up a little bit, to pay down the debt, do things that can be, that can keep us on a lifeline. Think of it as a lifeline for some time until we get down to the final part of the showdown, which is going to be the X date, which I'll go over in just a minute. But January 19th, 2023 is when we entered into an extraordinary measure. And Janet Yellen also sent out a letter to Kevin McCarthy, who is, again, the Speaker, House of Representatives. And she pretty much mentioned that in my letter dated to you on January 19, 2023, I noted that I had determined that the debt issuance suspension period began on that date. And that will last through Monday, June 5th, 2023. So they are going into some extraordinary measures. And after June 2023, there's going to be possible government shutdowns. There's going to be payments that are going to be prioritized to certain government departments. Because again, if the government doesn't have any money to pay its government employees, there's going to be priorities made, and some other payments are going to be deferred for a later time. And when they are, obviously there's going to be government shutdowns. And the X date is going to be that hard limit, where after that, all payments are going to stop. And there is going to be the highest risk of default for the U.S. government. And that is, of course, a very catastrophic situation to even think about, because, again, the U.S. government or the U.S. debt is considered one of the safest form of debt out there, the treasuries, right? They're risk-free. They're backed by the full faith and credit of the United States government. And that continues to happen. There's going to be significant ripple effects on other parts of the economy, not just in the U.S., but globally as well. So this is where we are. We have till June 2023. Once again, you'll kind of see in June, kind of a few months or few weeks earlier than June 23, you'll kind of see that resurface back in. Maybe in May, at the end of May, you'll see some headlines about the U.S. national debt and the debt ceiling being raised, what's going on in Congress, just kind of putting it on your radar and something that we need to watch out for. And of course, there's going to be potentially some government shutdowns, and then X date's going to be coming up as well. Janet Yellen also mentioned, again, this is back in January, that it would be devastating, and it is a catastrophe, and of course it makes me nervous. And Jerome Powell also followed, just I think 1 month later, saying that Fed's policies long-term damage if U.S. debt ceiling was not raised, and the United States risks long-term damage if Congress does not raise the national debt ceiling. Jerome Powell mentioned, I think this was back in March 7th, 2023, 18 days ago. We also talked about it, I think, briefly on the channel. Now, these are some of the estimates, or these are some of the consequences of a potential debt default of the U.S. government. This is, again, estimates put together by Moody's, I think. But if you take a look at, what is expected to happen if the United States actually does default on its debt, the GDP would fall by 4% from peak to trough. There would be roughly 6 million jobs lost, which I do still think is an underestimate to what could happen. Unemployment rate could more than double to over 7%. stock prices would be expected to drop by about a third, or in other words, 33%. And that's going to be wiping out close to $12 trillion in value. And mortgage rates, consumer rates, everything would spike. Because if you think about logically, right, what ends up happening in a debt default, right? So this is a very good representation of a Jenga, and you've got the entire financial markets, and at the very bottom you've got U.S. Treasuries, right? They are the safest asset out there, and this is really what we're talking about, because when the government is borrowing money, what is it doing? It's issuing treasuries, it's issuing bonds to other foreign countries, to central banks, to investors, foreign investors, and they're borrowing from them in order to facilitate and keep going its operations going, right? Their day-to-day operations, their day-to-day spending, to keep running their budget. Now, if they stop paying their debt obligations, if they don't really pay up on their debt obligations, which is U.S. Treasuries, which is coupon payments, right? If they don't do that, then well, guess what? The rating agencies are going to downgrade the U.S. Treasuries. Right now, they've already downgraded from AAA plus to AAA. The next thing you know, they're going to downgrade them down to AA, single A, maybe triple B. That's going to be a very, very, bizarre situation, because then you've got everyone who owns a government bond, U.S. Treasuries, is not going to feel confident that they're going to get paid. And guess what's going to happen? You're going to get an abundance of supply. You're going to get a lot of selling pressure for bonds, because everyone's going to run to redeem the current holdings of U.S. Treasuries. And that's going to absolutely create this imbalance between supply and demand, reduce the price substantially, and skyrocket the yields. And what's going to happen if this thing falls away? This is the foundation of the financial markets and the economy. Then you've got corporate bonds, you've got high yield corporate bonds, real estate and REITs and stocks and equities. Everything just falls over, because the foundation is obviously very, very on shaky grounds. That's what it would end up looking like. Now, this right here is a representation of what actually ended up happening in 2011, when the ex-dividend date was fast approaching, and it was like at the last hour, the U.S. raised its debt ceiling. So what really happened was we did see some riskier assets. So S&P 500, we got the NASDAQ, we had the U.S. oil fund, we did have Vanguard emerging market funds, some of the more riskier ETFs and high yield corporate bonds as well. All of them sold off, and the ones that actually did well during that time, ironically, it was TLT, which was a bond ETF. Then we also had gold that did really well, and then IEF was 7 to 10 year treasury bonds as well. So as soon as the debt limit was raised, that risk went away, the fear of non-payment went away, the fear of default went away, and bonds actually ended up doing well along with gold. But some of the more riskier assets still underperformed and actually sold off. So those are some potential hedges that we will look into as we get closer to the June date, the X date. Now, this right here is the U.S. total federal public debt. And of course, we're dealing with over $30 trillion. Back in 2011, we were shy of $16 trillion. So we are more than twice in the last 12 years. And the debt to GDP ratio back then was a little bit under 100%. And now it's well over 120%. So again, things are far more sort of enormous, so to speak, right? So the debt levels itself is colossal, and the debt to GDP numbers are also pretty substantial to begin with. So it's not going to be an easy task for the government to kind of fix this problem, because every single year we're running a deficit, which itself is obviously increasing the amount of national debt, and the interest alone on the national debt eventually will surpass, I think, over $1 trillion, which is going to be a problem of itself that we need to address at some point in the future. This is going to be the Fed's balance sheet. Again, we have talked about this, and it has also been growing quite enormously. And back in 2011, it was, at a mere $2 to $3 trillion. It was like really, really small. And that number has 4x'd in the last 12 years. So, we're dealing with very, very unprecedented times. And I just wanted to kind of do this video, kind of explain to you how the debt default pretty much works. What's the debt ceiling, where we are right now. So June 23 is going to be that timeline for us to pay attention to with respect to the X date, and keep up with everything that's coming out, and the probability of the debt default and where that ends up being as we fast approach the X date. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like, subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below if you're interested in joining. As always, happy investing. I'll see you all in the next video.